So how's everybody doing? Markets continue to hold up, not very much of movement here. Everything's kind of flattish. So nothing too exciting going on. Dollar's still hanging out below 90. Oil 68.71, 68.80. Gasoline 218, 219 says over here. And natural gas fell a little bit. So that's one of the things that we're going to talk about is with the news, and Bill's here. We're going to talk about reading the tea leaves on this energy stuff and seeing how it goes. Let's see. This morning, if I can open this in a new tab, maybe it'll be bigger. Oh, yeah. So, since middle of April here, we've been drifting along around 4,200, but it's, we're not really getting over it very much. We're kind of like testing. And there's a point at which consolidation turns into a downtrend. So you got to be careful about that because, there's a market exhaustion and the volume is sort of declining and we're holding up here and we're just going to have to wait and see what happens. Usually when you see this is these are down here on the PPO and the what is the other one? And these lines, when you see them forming down here, usually you're going to be coming into an uptrend when you come out of this stuff. But at the beginning, when it goes under, you can still be going into a downswing. So this doesn't really prove anything. It doesn't show you for sure. Like here you go again. Here we came out of this and went up, but meanwhile the market went down. So it's hard to get a read on what's actually going to happen. What you got to go by more or less is really saying what's going to get us higher. We're still trading at like 30 plus times earnings, 35 times earnings. The earnings are great compared to last year because last year everything was closed. Not to mention all the freaking money. All the money that was thrown into the economy in the first quarter, and everybody's high-fiving themselves and slapping each other on the back because our performance is better than last year. It doesn't make any sense. It's just you're not being realistic, and we're not. And I'm not saying the problem is we're not really playing. It's not going to get realistic for a while. There's no reason to be realistic because Biden's got a $6 trillion proposal, but the $6 trillion proposal is for this year's budget. He already spent $2 trillion in the first quarter, so it's not like there's any huge surprises in what's going on. Trump's budget last year was 5-something trillion, 5.5 trillion. Biden's is $6 trillion. Biden front-loaded his spending though, so all he's got really is the same $4 trillion the government always spends, plus the $2 trillion stimulus he already spent. That's a $6 trillion budget. And that means he doesn't have a budget for another big stimulus boost. Inside his budget is $6 trillion of infrastructure spending, but that's kind of spread out over 10 years, so it's $600 billion a year. So that means in the second half of this year, we're going to have significantly less stimulus, unless they come up with another new thing. But in the second half of this year, we're going to have significantly less stimulus than we had in the first half of the year. And we're not playing for that at all. Everybody's acting like this economy is not standing on its own. Not only that, though, but globally, India is still a complete disaster. Other parts of Asia are a complete disaster. South America is a complete disaster. We live in this world. It's all, we all live here. You can't just pretend it's okay that India has still got 3,000 people a day dying. That's 9/11 every day, 3,000 people dead every single day, day after day after day. And, and then infection rates are insane. Oh, I'll tell you a crazy thing. India, 40% infection. Now, something I read today, maybe it was the Times. Let's try the Times. Because you know the journal's not going to tell you these things. Ooh, does that work? That's not going to work. I used to love these charts. They took them out. So if we go to the Times, since it's a newsy kind of day, what the hell? Okay. India. Oh, we changed it. Recent Mayor, Stephanie, updates. Nope. Anyway, all right, so take my word for it. Look, stimulus checks substantially reduced hardship. Biden will announce a plan to offer free child care to caregivers while they get the vaccine. Well, that's not very exciting. Job losses, CDC, politics. Anyway, all right, so taking my word for it. What I read today in some paper of Valid, that 40% of the people tested in some province in India had the virus. 40%. Now, good news and bad news, because the good news is they're obviously on their way to herd immunity. Everybody's got it already. Everybody had it, and hopefully it'll burn out. They only have 3,000 deaths a day. It's a horrifying number. It's impossible to really conceive of it other than to say that's one 9/11 every day. How do you just move through that on a regular basis? But aside from the effect that that has on the economy and everything else and people's well-being and how people look at things and how the economy goes, and of course supply chain disruptions, because 3,000 people a day dying is disruptive. It disrupts the economy. If 40% of the people have it, they're certainly going to give it to everybody else very shortly. And that means that basically it should run its course this year for better or worse. And again, I'm saying only 3,000 people a day are dying because there's 1.2 billion people in India. And with that kind of infection rate, it's incredible that few people are dying. So maybe they have a more virulent, but milder cases of it. Who knows? But what it does mean, though, is still we're not out of the woods yet on this stuff. In the U.S., only 500 people a day are dying. So we can totally ignore that, basically the way we are totally ignoring that. Because apparently, who cares if 500 people a day die? 22,000 people a day are infected. That's a lot, but and some of those people will die too. But again, we're ignoring it. We're basically in the U.S. pretending that everything is completely hunky-dory and we have nothing to worry about. Europe is not that much different, although there are lockdowns in certain places. And like I said, though, in Asia, China, Japan are being careful but open, and other parts of Asia are in bad shape and taking precautions. And South America is a complete disaster. It's almost just out of control over there. But again, okay, fine, so it'll burn itself out. But that still doesn't mean that we should be playing as if we have the best economy that ever existed. That's what drives me crazy. It's like, how does this give you all-time highs on stocks? How do you say how great everything is? How do you have these projections for such growth when all we're trying to do is just get back to normal? We're just trying to get back to normal. We're not even close to normal yet. And so why are we at all-time highs? That's the issue I have with with the market. But meanwhile, that hasn't stopped us from making trades. So yesterday we added Philip Morris, or Altria, sorry, I always call them Philip Morris, but they're not. This is Altria, which is the American part of whatever you call it, what used to be Philip Morris. And we had a good dividend case for them. Last week, U.S. Steel, Rio Tinto, SunPower, and Walgreens Boots was still a bargain. And how's WTRH doing? You catching up? That's a Grubhub competitor. Let's see what the chart looks like. Ooh, I don't have a chart. WTRH. Oh, look, yeah, catching up. Great. All right, so anyway, so it's still, we're still picking stocks and finding things to trade. And there's no reason not to, as long as I was talking about this morning. Oops, got to go back to this again. Or here, as long as we're holding this is a rising 50-day moving average, and it's a really solid, straight up thing here. But as long as the rising 50-day moving average is giving us support, there's nothing to panic about. And you're going to have good support here at the 200-day moving average, which is also rising parallel to the 50 days. So you have a very strong support area here. It's unlikely we're going to go flying through here, and this is only 10% down. And of course, 10% down is painful, but if you have really strong support at 10%, you don't have to freak out about am I going to have to suddenly get out of the market or something like that. We should have plenty of time to unwind things should we have to. But more importantly, we're going to be watching this. Now, the biggest danger you have, though, when you're consolidating up here and your 50-day moving average is rising like this, what's going to happen is, what a death cross is, right? A death cross is when death cross is when the 50-day moving average falls below the 200-day moving average. So in other words, that's called a death cross. We're nowhere near that happening. That's not going to. But what happens, though, is when the 50-day meets, when you are consolidating up here, right, you're forming a zone that may be the top. When the 50-day crosses that top, which is going to happen, how long is this? This is May 10th, and it's June 2nd. So about 21 days from now, if we don't start moving up from 4,200 in 21 days from now, at the end of this month, basically, the 50-day moving average, if we continue up here, the 50-day moving average will cross this, and so by default, you'll fall below the 50-day moving average because the average has gone to where you are. So if that happens, and whether it happens because the 50-day goes up or this one starts going down or the daily starts going down, either way, what's going to happen is this curve line is going to start bending lower, right? But as long as we're still in the upper end of this range, the 200 is going to keep coming up to meet it. This one's going to start bending down, and then you're going to get the dreaded death cross where the 50-day will cross under the 200-day, because the 200 days got the momentum and keeps rising until this falls down. So actually, if you want to maintain the strength, what you really need is a sharp sell-off that quickly reverses to take some of the pressure off the situation. But if we keep consolidating at this level, it's actually pretty bad because you're inviting a problem when the 50-day creeps up to a little bit higher. But again, so from a standpoint of us investing, that's 21 days away. If anything bad happens before then, all that's going to happen is we're going to hit the 50-day moving average. It's not likely. It did happen here, though, pretty severely. It's not likely that we hit the 50-day and then collapse into this zone. Usually you're going to bounce off it a bit. And even this was only a one-day. This was a one-day event that we fell below and then came right back. But it's not likely that this happens. What's most likely is that you bounce off it like this did, like bounce up, bounce back, bounce up, and here fail. So we'll have time to unwind. We'll have time to protect. We'll have time to add hedges. So therefore, since we have plenty of hedges, we feel that we're going to have time to add hedges, and we have a lot of cash. There's no reason not to add longs, and that's what we've been doing in the last couple of weeks, is adding more longs. And in that way, we're sort of protecting ourselves from the market being stronger than we think it's going to be. But we're adding sensible things. And we talked about this last week. We're adding commodities. We're adding inflation hedges. We're adding blue chip stocks. We are not adding any of these high price momentum things. And I don't want to go over the whole portfolios again, but in the dividend portfolio, for example, we've got Viacom, too cheap. We added that recently. Let's see who else we added recently. Annaly we added recently in April because it was too cheap. It's a mortgage REIT. PetMed just started taking off, but we added them a long time ago. Oh, that's 2020, so that's a long time ago. Or in the long-term portfolio, I guess we could look and see who we've added. See, in the long-term portfolio, it's been very flat lately. It's still at 1.9 million. It's not quite getting over 2 million. Look at the recent things we've added. Akamai, Boeing, just basically Boeing, you know, we sold some puts to see where it ends up. DISC we did, Discover. What else? Frontline in March. Labor is the biotech ETF. Mitsubishi Financial. This wasn't that old. The oil services, we figure, you know, more oil production, more oil services should do good for them. Rio, we just added, was a top trade. TD Bank is an undervalued bank. Trox is the they were part of Alcoa. They're actually more of the in the, you know, the aluminum space, so it's another way to take advantage of the commodity. And you know, look, we did it in March. We're already up 68%, so that's how that goes. Chimera Investment we added in April. You don't realize how much stuff we add. It's funny how you don't like notice how much we add. It seems like everything's boring and we're not doing anything, but meanwhile we're like, look how much of this portfolio has been added in the last 6 months or 5 months. We have Total, which is our favorite oil major because they're basically changing themselves over. We added Alibaba this year. We added Big Lots. We added Facebook was added this in March. I didn't realize that even. They got cheap, so we bought. Remember that big dip in we had a dip in March, so it was worth buying some stuff. We added Barrick Gold back. Lloyd's we like because they got too cheap. And oh, they popped. Wow, look at that. Whoa, geez. Okay. So I mean, they had to be less than 245. We bought the $2 calls for 45 cents, so whatever they were at the time. But look at that, it's up 88% already. And that one's up 61% because it's a short put. We didn't sell the $3 calls. We were waiting for them to pop, and they really took off already. That's a fun play. I like that one. NRG, we like those guys. Petrobras is another oil company we decided it was too cheap, so we picked it up. That was back in March again on that nice dip that we had. PHM we picked up. QSR we added, was the restaurants. REYN we added. Wow, I really didn't realize we added so many this year. It's crazy. UBS, wow, we cleaned out this portfolio. It's like so many of these positions are new. Viacom, of course, you guys know I love them. Valero, again, is a refiner. We thought they would have a good year, and of course they're flying already. Wegmans we shorted. This is a short. How are they doing? 330. So not doing so good for us so far. It's actually, we're negative on that one at the moment. They're higher than our range. They're higher than the range we expected so far. And then here's Walgreens again, which we've had for a long time. Wheat and precious metals we added to take advantage of the metal boom, and that thing's flying already. And Western Union we added. So I mean, crap. It was like, I'd say a good 2/3 of the long-term portfolio is new positions we took this year. And the performance is, of course, outstanding, just because we, but notice there's nothing here that's like a trendy name or anything like that. None of these positions are things that are flash in the pan items. These are all long-term solid companies that you're like, well, that's not a very exciting pick, and that's not a very exciting pick, and that's not a very exciting pick. But when you put them all together, we have a portfolio that's up 286% in not even 2 years. This is back from October 2019. Boring picks work. You just, boring picks with hedges are the way to go. It's like, you don't need to chase crap. And especially in this kind of environment, it's just not worth it. So let's see if we got some questions. Brendan has questions. Do you think the 150 SCO 6/8 call spread should be adjusted here? I don't know what he means by 150 SCO. Do we have that many in the short-term portfolio? Sounds like a lot. Oh no, we do have that. Holy cow. That's funny. All right. Well, I mean, obviously, we already looked at this in the last review. I honestly have no memory of what we did. I don't think if we did anything, it would be reflected here yet, because we haven't gotten around to doing the update. So he basically means, should we, because SCO is the ultra short oil, it's getting killed because it's going down. So it's at 20. Didn't they, it's at 20. This is a 6/8. This split, they did a reverse split. So these numbers are all wrong. So I don't think, oh yeah, the new 24.32. So this hasn't been adjusted yet. That's the problem. We have to adjust it for the new spread. And should it be adjusted with crude at 69? Oh, is it 69 now? Where are we? Oh, look at that, nasty, 69. All right, so are we going to adjust it? Oil is going to go up in the summer, and this is a play for January. So it's not outside of the possibility. We certainly knew it could easily go to 70 during the summer. Next month, July 4th, is when we would make a final adjustment and say, okay, this in July 4th, that should be about as high as it gets for the year, and after that, it should head back down. So should it be adjusted? We'll have to just wait and see what happens on July 4th. It's not probably worth, it's a very small split. It's a $2,000-$3,000 spread, and it's, we aren't going to be up or down very much on it, so it's not a heavy position. We're just going to wait and see what it looks like in July. We're not going to be jumping into making adjustments just because it's getting near 70 now. And Brendan's asking, what are we doing with short Facebook 310 calls? Honestly, this is not the time to do a portfolio review, but ask during chat, and we can do that. Wayne says, what new positions would you initiate on Pfizer and gold? Or are they already too expensive at this time? And also, again, ask that question during chat because we can get into it more seriously. But like I said, gold, we just did a top trade on. So it was, we just did a top trade alert on gold. I don't think Pfizer got kind of expensive, so I'm not too keen on adding Pfizer again. We buy things when they're cheap. So when you look at the chart and you say, well, there's a stock we like and they got cheap again, somewhere was gold, Big Lots, Viacom. What the hell? Didn't I just say we did it as a top trade, or did we just got added to the LTP? I guess it wasn't a top trade for some reason when we did it. X and Rio, SunPower, WBA. I don't know, it wasn't a top trade. It was just a regular add-on during member chat. But like I said, we actually, when we did it, I knew we did it. In the Money Talk portfolio, we just added gold back in. And I bet that's not in here either yet. Oh no, there it is. Okay, so on 5/13, which was what, 2 weeks ago, we added this gold play. So yeah. And where's it at now? 24. Are we up much? We're only up about we're up about $1,000 on this position. So it's close to where we were. The net originally was, what is that? It was a $3,000 spread. Now it's a $4,000 spread, so it's up $1,000. But 7 times 25 is 7 times 25. It's a $17,500 spread, and you can still enter it for net $4,000. And we're only aiming for 24. We're $4 in the money. That means we're $10,000 in the money, and you can still right now buy this spread for 14,875 minus 7,425 minus 3,525. 39.25. So that's the price is right. So for 39.25, you can buy this $17,500 spread. So your question, which is what new positions would you initiate? I'm sorry if you missed it when we did it. In the member, this was a live one for the Money Talk show the other 2 weeks ago. But if you didn't do it at the time, you only missed the first $1,000 of the potential 14,500 in gains. This is simply on track. It's supposed to make $1,000 a month. That's how you go from $3,000 to 14,500. You make $1,000 a month. That's how it goes in. So there's that. Pfizer, on the other hand, though, Pfizer was a well, it was free, obviously. It was 8 minus 5 minus 3. So Pfizer was a zero cost spread, and now it's 9025 minus 4075 minus 1405. So now it's a $3,500 spread. So we've actually made $3,500 so far, and it's only a $7,000 spread. Now, again, this is a this is a PhilStockWorld problem. This isn't a problem normally for people. This spread will only make 100% in the next 18 months. It's 100% in the money. The spread says Pfizer will be at 37 in January 2023. Pfizer is now at 38.78. So if you right now buy this spread for 35.45, if Pfizer fails to fall below 37, you will get $7,000. You'll make 100% on the spread. We bought the spread for zero. We're already up $3,500. We're going to be up another $3,500 by hanging on to it. Because we bought it when we made the call. But it was a long time ago. That was October of last year. So in October of last year, we liked Pfizer. And that was so obvious too. Oh my God. and so we've made half the money we anticipated making. We've made it very quickly. We're ahead of the schedule, but meanwhile, it's still a fantastic trade. I mean, if you tell somebody, I have a trade that can make 100% in 18 months, and all Pfizer has to do is not go lower than it is today, and you'll make 100%. And your worst case scenario is owning Pfizer for 35, which is 10% below the current price. So would you like to be in that trade? Only we have a very weird group at PSW because only PSW members go, ooh, is that all? It's like you're only going to make 100%. Why am I going to bother with that? Because we do these trades with it's a conservative stock. There's no reason to think Pfizer won't maintain 37. It's a simple option spread, and we take it. But you missed it only in that you didn't get in when we got in a few months ago. But is it still a good trade? Sure, any trade that makes 100% in 18 months is a good trade. But it's not as good as this trade on Barrick. But Barrick isn't 100% in the money yet. But that's what you got to do when you're looking at trades. Any of these trades on the board, you just look at the current price of the spread, and you say, okay, well, this is still valid. This is still a trade I would want to be in. Look at the Viacom trade. That's up Here's another example. The Viacom trades up minus that is 52, so it's up about $4,000, let's say, and but this is supposed to be a $30,000 spread, and also practically in the money. And currently, the net of this spread is let's see, 23 minus 32 is $9,000. So it's $9,000 on a $30,000 spread. Do you want to make $21,000? And you didn't miss anything, right? Making $21,000 on $9,000 is still pretty good. But meanwhile, we started off at net, what's that, 22, blah, blah, blah. So we started off with $5,000. We already made $9,000. We already made 100 and something % profit already. And we're going to keep going and make another whatever the hell, another 21,000 on top of that. Is it valid to start at 9,000 and make the money? Sure it is. Why not? All right, so it's 1:30. Let's see if we can find Bill. Let's see. What do you think about ENB for the dividend portfolio? Don't know. And another one you can definitely ask in member chat, because that's they're probably okay, but I haven't looked at them lately, so I have to go through the whole thing. Now let's see if we can find Bill Olson. Yes, we can. Okay, so we say change presenter, give keyboard and mouse, or do I just turn on the sound? Let me see how this thing works. Audio. Oh, hey, how's it going, Bill?
It's going good, man. How you been?
I'm good. All right, I didn't know your mic was on. That's good. Okay, good. So Bill Olson is from Newsware, and we've had him on before. He has this fantastic service, and he's going to show you the program. But what I want to discuss today, Bill, is we talked about it briefly this morning, is how we use the service to make money reading the news and then following up on it. So I guess while you're showing some stuff, I can talk also, and we can get some of this stuff going.
Yeah, I mean, listen, there's if you're looking at the fundamental data out there, there's so much meat and there's so much gold and nuggets in some of these stories that, you know, stocks react in different times, right? You know, as you know, right now we're between a rock and a hard place, you know, between this, you know, opening of the economy and the inflation concerns. You know, this tussle is going to be with us for a while, but, you know, we'll get out of the worries of inflation soon enough. And then you're going to start really looking at what these people have said and how it's going to affect earnings, how it's going to affect stock prices. And there's a ton of opportunities out there. You just got to look at them, analyze what they mean, and there's profits to be made.
Yeah, and today, in fact, we'll start with that, because we were looking today at oil, trying to figure out, like, why was oil going up, and is there a valid reason? Should we be changing our target, which was to short at 68.50, and did anything particularly happen that would make us want to change our mind about that spot? We did get up to 69 today. This morning I said, no, I still want to short at 68.50. We had a little run back to 68. That's a 500 profit. Then it went back up, and I said to the members in chat, I said, don't play it if it goes back over 68.50, because it's probably got some legs. So now we're at 69. Now we need to take a closer look and say, you know, what's valid? What happened today that should make us change our mind one way or the other? So anyway, let me expect to make you the presenter. Think I can? Are you sure you want to make Bill the panelist? Yes, I do. All right. So what happens now? Waiting for Bill's screen. Oh, okay. I guess it's going to change over to your screen. Can you hear me still?
I can hear you.
Okay, great. Oh, look at that. There's Bill's screen. Fantastic.
All right, there you go. You know, at Newsware, you know, we're really focused on just taking in the quality news feeds. And this information that you find on the internet, it's not good data. You want sources that full feeds from the press wires, you know, and sources like Dow Jones, even Fly in the Wall or SEC filings, because this is what is being used on the institutional desks. This is the data that people are relying on to trade with, because there's better information off of Dow Jones than you're going to find on, you know, Yahoo Finance. It's just there. They have professional reporters, and this is what they do. I mean, we talk about oil. Dow Jones has this oil reporter that I follow. Her name is Summer Saeed, and she's based in Kuwait. And she follows the OPEC, meetings. She's talking to the ministers. And I remember last year during the height of all this OPEC, when oil was, at $20 a barrel, she was in there talking to these OPEC ministers, and they were telling her specifically what was happening in the meetings. Now, the announcement is until Thursday, and she wrote about it Tuesday. I had it Monday because I have Dow Jones on my scrolling news feed. And I bought Chevron that day, and I'm telling you, a week later, I made $10 off of Chevron. I couldn't believe it. But there's value in really good reporting. It's profitable trading, especially when you see the ideas and how they match up. One of the neat things about Newswire, what we do is we're indexing every word of every story. We catalog and categorize the metadata from every story. By doing that, you can create better, more succinct filters and access the data that you're looking for more quickly. We have a host of these news codes that we utilize. Some are, come directly from a vendor. Some of them are ones we call master codes, where every vendor has an earnings news code. So let's just make one single code that everyone can utilize. And we offer Boolean logic, so you can tie, a stock ticker into that earnings code. So it's just the earnings news on a particular stock. But I have a number of little trading models that I utilize all the time. And one of them, I'm just going to show off, I have this, I call it my CEO alert. And it's nothing fantastic. All it's doing is it's showing you stories where there has been a change in a CEO. So how I built it was I just use S&P 500 stocks. I'm only using a short list of keywords and phrases such as CEO resigns, CEO quits, CEO to leave, CEO arrested, CEO dies, things like that. And only the press releases where it's about management changes. Now, the reason why I do this is because in the first 45 minutes of when there's going to be a CEO change in a S&P 500 stock, the stocks typically tend to drop 1.5% to 2% in the first 45 minutes of trading. And I know this because, I tracked it for a year and my model was right 49 out of 50 times. And how do you, find out when CEOs are resigning or quitting? It's in Newswire. It's not going to be on CNBC. If it's in the Wall Street Journal, you miss the trade, but it's a profitable trade. And you look at Tyson Foods this morning, in the first 45 minutes, it did nothing but go down. And I believe that the hedge fund managers, the big money managers, really are selling a portion or a small percentage of their positions because there's a different change in leadership and they might not know the new person coming in. So they're just taking a little bit off the table. Hey, that little bit drops the price 1.5% to 2%. In 2019, as I said, I followed this for the entire year. And if you followed the model I created, it was right 49 out of 50 times. The only times that it doesn't really work is when the stock's trading at the 52-week low, which is why I didn't employ it last year, because everything was trading at the 52-week low. So it was kind of like I was trepidatious about using it last year, but we're past that. So now I put it back on. It's on my alerts, Tyson Foods this morning. And sure enough, the stock, you look at Tyson Foods this morning, and where it opened up at $80.50, and then went as low as, and then it dropped a full dollar after that before it started coming back. But that's more than the 1.5%, so it was a good call. And I've seen it with Intel. I saw it with McDonald's when they announced a CEO change and the stock was already down $4. As soon as the market hit, it went down 12 that day. So it's a good alert to watch for. But we have other ones that you can utilize. I have an FDA alert, which is really just focusing. I only want to see ones with ticker symbols. I don't want to see anything where it's just an FDA story, so I keep it pretty tight. And I'm looking for those catalysts that are going to move the stock. You know, I'm really excited about this Biogen, this BIIB, only because they have that drug and they have that PDUFA date coming up, and that PDUFA date is June 7th. Now, I don't know if they're going to get approval or not. I know that there's a lot of questions about the data. I know that there's a lot of concerns where the drug company says the drug is 30% effective, whereas in John Hopkins doesn't say that it's 30% effective. They say it's much lower than that, but it's an Alzheimer's drug. And would you be willing to accept a drug that's 24%?
Yeah, if it's any effective at all, then, you know, maybe.
Yeah, so there is a good chance that they could get it. And if you remember a couple quarters ago, that stock moved $100 on the news. You know, but then that news said, no, it's too early. We didn't approve it yet. And the stock dropped $100 the next day.
Well, I mean, there's a lot to take in. It's 30% effective as doing what?
It's 30% effective as reducing the symptoms of Alzheimer's and, you know, less memory loss.
Right, but how much less? And you know, it depends on what, you know. There's a whole bunch of factors to say. What are you really getting? When is it going to be effectively used? What percentage of the patients does it apply to? Blah blah blah.
But the trade here is not holding it into the date. It's the run up into the date.
But I'm just saying people are not very rational about their moves on these things, so you do have to be careful.
People, you know, the stocks like to run into PDUFA dates, and they like to run hotter. And as soon as the news comes out, these stocks fall apart. They're never typically able to hold these gains, and portfolios are, you know, covered with losers of a PDUFA date that maybe it went good, but you held it too long. Right. I don't like to hold it into the date because that's where the real risk is. You know, I'll hold some into it. I did some this morning. I made a little money. I was happy with it. It was a good trade. But I like that Merck. Do you know what's going on with Merck, Phil, and that new drug that spinoff they're doing?
No, I wasn't paying attention. I don't honestly follow the biotech market that closely because
Merck's, you know, $78 stock, and then they announced that they're spinning off a division, and that division's OGN, I believe, is the ticker symbol, and it's going to start trading tomorrow. The key here is that stock's going to be added to the S&P 500 when it starts trading tomorrow, day one.
Yeah,
it's already profitable. Yeah. It's already profitable, and according to the news reports, you get 1/10 of a share of OGN for every share of Merck that you own. So you do the calculation, and as I was looking at it, if I can pick up Merck at 74, it's a really good buy here. You know, and we do this podcast, as you know, every day at Newsware, and you know, I was like, listen, Merck's going to run, and that was my stock of the day today because I just believe that there's going to be some additional momentum in Merck. And this trade might take a little while for it to really show the gain, but you know, you're doing a spinoff, you're going to get the stock from the spinoff. I've already owned the stock for a while, so you know, I'm part of the deal that's going to get the OGN shares, but I'm going to be owning OGN and Merck, and I think Merck will come back to that $78 range in the very near future, and then I'll have that OGN just as, like, you know, free stock, and there's nothing better than that.
Nope.
You know, but you know, a quick little tour of some of the things that you can do with Newsware is I wrote out some of the codes that I use on a regular basis. This is one from Dow Jones. It's really good, and I follow this all the time, and it's in my hot news alert above. And this is just exclusive news. It's coming from Dow Jones News first. This is news that they brought, and they hit it to the tape first. What's better than being the first to know? You have Dow Jones. Dow Jones was the first to report that Elliott management has a big position in Dropbox, and they've been in talks since earlier this year. I mean, it was a good story, and you saw Dropbox move off of the news. So, you know, that guy Singer, Paul Singer, he's the real deal. He, you know, he's a big fan of newsware as well. But this is just one of the ways you can see breaking news is to follow these exclusive news alerts. And every vendor has something, whether they call it market chatter or they call it, you know, hot news. Dow Jones calls theirs exclusive news. It's a nice one to follow. You know, you do a lot with the oil. You know, we had those API numbers, I believe, came out today.
No, they delayed till tomorrow because of the holiday.
And so tomorrow we're having both the API and the Department of Energy figures.
Oh, I'm sorry. API might be tonight. Yeah, API may have rescheduled to tonight, but the EIA is going to be tomorrow.
Yeah. But I mean, you know, where is all oil going? You know, there's a lot of news out there. You know,
well, that's the thing. Like right now, it hit 69 just recently, right? About about an hour or so ago. At 110, in fact, it hit 69. So here's the question: what happened at 110 or around 110 that made it hit 69? And do we feel that that's a sustainable hit, or did somebody just say something? You know, this is how I use the program. I mean, that's what I'm going to look for. Say, why did it pop up at 110? What happened to drive us to 69? And then I want to look in there and say, what caused this? Who said what?
Yeah.
And I see in French there's some announcement that somebody said. Who knows what they said? But who said something that drove it up all of a sudden? That's what I would want to know. And if it's nothing, then I want to bet against it, because I'm saying, well, what the heck is it popping for?
You know, I mean,
I don't see anything.
I can't believe oil is at this level, and I'm not going to fight the tape. I don't fight the tape because that's.
Oh, we do.
Yeah, I mean, well, your positions are longer term, so you can. Mine are shorter term, and you know, the worst thing you can do when you're short term is try and fight the tape. And I look at oil and I say, you know, look at the production. It's going up. Well, when production goes up, that's actually that oil prices should go down. You know, Iran is out there. They're going to start. They have the ability to produce 4 million barrels a day. There's those conferences, those talks about the accord, whether they're going to put it back in place. It looks like nothing's going to happen. But if it did, that oil would be coming into market, you know, they say midsummer. There's a big talk of how this summer driving season is going to be a swoon and everyone's going to be using oil again. I still am not a big buyer of it. I feel that that with all this new production, they're going to create another glut, and oil prices may be able to push higher in the short term, but you know, these guys love to cheat. And Russia's always pushing for more increases to production at every meeting.
Right. People don't realize how much OPEC cut back last year. They cut 1/3 of their production. 9 million barrels was cut of OPEC production. And so far this year, they put back about 4.5 million of the 9 million that they've cut. We still are operating at 4 million barrels plus under capacity in OPEC. But what that really means is, first of all, if Iran comes online, they can sell whatever they have. If anybody wants to expand their sales in America, Russia, or somewhere else, they can expand their sales and take market share. So OPEC has to play a very careful game of pushing their supply higher before somebody else comes in and fills any kind of gap that they leave in the market. And what I see happening at these meetings of OPEC is that's what they do. They agree to a production increase, but then they talk up demand because they want to give the impression that they're there to meet the demand. But the demand isn't really moving up that quickly.
No.
That's what people aren't getting.
I mean, let me ask you this question. The airlines are one of the biggest buyers of jet fuel and oil.
Mm-hmm.
Do you see the airline industry coming back, whereas in airline traffic?
Yeah, that's not my issue at all. I think airlines are back to something in the neighborhood of 80% capacity now.
They're at 80%, but I don't see them coming back to 100. I still
No,
see
no,
them.
no. But 80% capacity doesn't really mean less planes fly. It means the planes are less full and the airlines make less money.
Yeah.
As you know, last year they were flying planes with 2 people on them.
Yeah.
Because there's stupid rules about them having to keep their routes, and if they don't fly the planes, they lose their routes. But that's idiotic in a crisis. But we did it anyway. Oh, look at AMC pop 95% just now too.
Remember the last time we were one of these pre-meeting calls we had, we were talking GameStop and AMC.
Yeah.
And we both said, listen, it's gonna continue for the foreseeable future. And sure enough, here we are, 4 months later. It would have been a bad idea to short them now. But, you look at GameStop, it's a bankrupt company. I don't see AMC achieving profitable revenue and being able to dig out of that hole that they're in, but they're still trading higher.
No, that's silly. We just stay away from it. I mean, we stay away from GameStop.
Stay away from it. It's not worth it.
There's no rationality to the trading. Although we bought Pets, Pets.com we bought because, not Pets.com, yeah, it's Pets.com. We bought Pets because we liked them as a company and their value was good. So the short squeeze in that case, which happened today, it's up 30-something%. That benefits us. But with GameStop, there's no value there. It's just way too high in AMC too. AMC is basically teetering on the verge of bankruptcy. And they gain 100% today. It's crazy.
Thank you. It's true. They're teetering on bankruptcy, and for it to be up 100%, it could be a $200 stock and then just have to file Chapter 11. I mean, it's absolutely possible.
Well, the GameStop CEO stepped down.
Yeah.
So his stock went up 1,000%, and he had to step down because the company's not actually making money. Who cares if the stock went up 1,000%? It's still not being run right. It's still about to fall apart.
Well, they don't have a business model that is sustainable in this environment, or the way the business is going.
GameStop has been in trouble ever since apps came about. I mean, apps is what killed GameStop. It just was doing it slowly, and then this happened, and that was the last straw for them. But then they got saved by Robinhood, because basically everybody was like 98% shorted the stock. I think it was over 100% shorted, in fact. And then all of a sudden they start this insane program, which was correct though. The guy who analyzed it on Robinhood was right. He said, you know what? There's so many people shorting the stock that if we start buying it, they'll be screwed. Yeah. And that was correct. He found a flaw in the system.
And he doesn't feel like he's hurting anybody, but at the end of the day, when you're having people that buy these stocks on margin, and those margin calls come in and they can't meet them, the brokerage firms, have to, they have to take a hit. This caused a ton of firms to go under in '87, and it does hurt. It does hurt people. It's not like it's a free lunch. Margin trading in some of these, high flying meme stocks, it's really dangerous. I don't do anything with them. I watch them, but
you don't really think that's why. And I was just talking to people today. I'm just like, we don't play these stocks. You don't have to play these stocks to make money.
No, you don't.
In a portfolio, it's like, why would we mess around with this stuff when there's perfectly good stocks like Viacom that we could buy at incredibly cheap prices and then leverage that with options, and then we'll make 300% on Viacom.
Yeah,
and the Pets one also, it's the same thing. We're going to make 100% on a very conservative dividend play on Pets because it was simply undervalued, and we played it to be undervalued, and we leveraged it with options.
I do this semi-straddle trade all the time, and what I do is I use the straddle price. So I know the stock's expected to move 5% or 10% ahead of when the earnings come out. And a couple of weeks ago, I was watching Airbnb. Now, the stock, dropped $12, which was past what the straddle price was saying. So I bought 500 shares of the stock, and I did make a mistake. I didn't buy 500, I bought 550. So I got out of the trade, and the stock started moving up later in the session. And I believe I made a couple dollars. I was happy, and I sold out my 500. And the next morning, I realized I bought 550. I bought them at $128, I think it was, and I'm still sitting on that 50 shares, the odd lot, the mistake that I did by overbuying. It's up over $1,000 inside of a month.
So despite yourself, you're making money.
Despite myself, I mean, I hit the 5 twice. It was my mistake, But how many times have you made a mistake entering an order and it's turned out to be valuable for you? It's
well, I'll tell you honestly, I do that sometimes if I fat finger something or whatever. A lot of times I like leave it and watch because I'm like, you never know. Sometimes it works in my favor, sometimes it doesn't.
Yeah, I know.
But it's so much. But you know what it is to me? It's like the fun of it working out well so outweighs the disappointment you have when it doesn't work out. It's just for those times when you just tend to make a lot of money. It's like and it was a mistake. That's so funny. It just makes you feel great. Oh, somebody's asking. Brendan's asking. He says, "How does your service compare to the Bloomberg Terminal scrolling news feed?" How would you sum that up? It's certainly a lot less expensive.
Well, yeah, it's 1,000 times less expensive. It's 2,000 times less expensive, number one. But you look at what we do here is we have direct licenses with all the publishers that we do business with. That means they know who we are. We have a direct feed from their organization to ours, and we have rights to distribute the data. We are paying them for the content, which means we get the full text, just the same as Bloomberg does. Bloomberg has access to Bloomberg News. We do not have access to that source. But let's look at the differences. You're talking about paying $2,700 a month for 3 years for a Bloomberg terminal, or Newsware, where you're essentially month to month, and our rates start at $50 a month. So it's night and day. It's different. This is an opportunity. You can see very closely if it's working for you. You can see very closely the type of content that we are delivering, and you look at the Newswire from Dow Jones. It's the same as Bloomberg, except ours also includes it not only includes Dow Jones, but it also includes Barron's Online, Wall Street Journal Online, Market Watch. All of that is combined into the single feed. So you're talking a significant amount of news stories, and and over Newsware, you have that ability to have 3 months worth of history right away on your fingertips. If you want to expand it, you can go even further, because we do store a total of 12 months of history for all of the news vendors that we carry. I hope that answers the question.
Yeah, great. Hey, so the Fed Beige Book is out right now. So we can do a John Henry thing here, because usually John Henry's the guy that they tried to beat the machine in the competition or whatever it was. Was it mining or something like that, or digging a tunnel? Digging a tunnel. That's right. He was digging a tunnel, and it was man versus machine. So, question is, what I would ordinarily do, and I'm going to do it right now while you show the folks what you're doing, is I'm going to go to the Beige Book, and I'm going to see how I can figure out what it's doing, and let's see what you figure out from your system on what you get from the Beige Book. So I'm clicking on my side. I'm going to the Beige Book itself. I'm going to actually read it a bit, and I'll tell you what I see. But you shout out as soon as you see something.
I'm looking for I thought it would just pop up right away. Beige Book.
Aha! See, I'm already reading it.
No, that's okay.
Home building is strong demand. I'm just seeing if there's anything important here. It's very, very limited information. Demand.
Economic expanded at a moderate pace. Okay.
Staffing level, steady pace. Everything is a very boring beige book, unfortunately. There's nothing going on. Everything just sort of continued from the last one. Same crap. Growth is moderate. Inflation is increasing. A lot of price pressure since the last report. That's the main thing, is inflation is kicking up.
Well, that's to be expected. I mean, we've been knowing inflation's been kicking up for a while. The Fed has been very clear that, inflation's been an issue that we're going to start running hot again with. And I'm not really concerned about it. I mean, I do pay attention to, the GDP numbers, the CPI, the retail sales, and the PPI figures when they come out. But for the most part, you see all these FOMC members, they're touting the line when they say, and they keep saying we're expecting inflation to run hot. They talk about their 2%, guideline or figure that they expect to see, and they're letting it to run above 2%. And they have no plans to raise interest rates this year. Everyone is pretty much on the same, speaking in unison, except for Robert Kaplan out of Dallas, who basically is out there. He's not in step with them, and he's the most active guy in the circuit these days. And he wants to push for discussions about really pulling back the central bank's bond buying stimulus program, and he wants to start having that discussion now.
Right.
He's not an FOMC voting member, but this guy was former vice chairman of Goldman Sachs. This guy is one of the real most influential guys on, of all the FOMC guys, and him and that Neil Kashkari guy from Minneapolis. These are two of the more intelligent guys out there. I like Robert Kaplan. I think he speaks well, and I think he makes a lot of sense with his comments that he brings to the table, especially on his speeches.
Oh yeah, they lean heavily on him for stuff. I see Harker made a thing though. He's talking about it's too soon to talk about tapering at the moment, and they've been throwing that quote around all day.
Yeah. I have a Fed alert that I follow.
Meanwhile, though, here you go. Because see, what I said was pricing pressures. As though you just clicked away from it.
Oh, sorry.
What I just said on the beige book. The pricing pressures increased further since the last report. They're pulling up the same significant thing that I pulled up. It's that's the most significant thing in this report. Otherwise, though, it's a very dull report. There's not much of a reaction to it. Nobody gives a crap because it didn't say anything different than the last one.
No. But I have a Fed board alert that I follow, Phil.
Yeah.
And basically, what I built it just by inserting the names of all the people on the FOMC committee and the Fed bank presidents, and a few other people in there and a few keywords.
That is a good alert. I like that.
It's just very clear, succinct, and I know what I'm looking for. And I go to this global energy. What is in there? Well, they talked about the Federal Reserve in there.
Yep.
So here's your Harker story.
Yeah, what I would want to have is a thing that tells me anytime somebody from the Fed says anything, I want to know about it. As far as
that's what this does. That's what this alert does. And whenever it's reported, I pick up on it.
Well, the things I wouldn't want if they just because it mentions the Federal Reserve, but if there's a headline,
I could just put the
headline. Because I want to know if any of their names is mentioned or the Fed is mentioned in the headline of the story, because that's going to get a reaction from the market usually. But see, what I find interesting is that at noon, Harker said the thing that they quoted about the bond buying taper, and then at 2 o'clock though, it's been repeated on your other screen there, the alert screen.
Yeah.
And I always wonder about the way those stories circulate, because it's like they want to push. You can tell they've got an agenda they're pushing because they shove it out in conjunction with the beige book, so that you don't get the idea that from the beige book that maybe the Fed should be tapering. They want to make sure that somebody's saying no, there's no reason to taper anything based on this beige book, even though it does sound like there's inflation.
Inside an alert, I can suppress any type of duplicate stories. but these are two separate alerts, and they're from two separate news.
Oh, no, I understand that. I'm saying, though, that to me indicates that somebody's got an agenda and they're circulating the story. They're pushing it out there because they want it to be seen by people and they want to time it.
You know, when you talk about like timing of the news releases, we're not a news organization. We're simply an aggregator, and we don't deal with a lot of these news wires that are known for copying and rewriting stories. For the fact of the matter is, it takes time to do that. After 15 minutes, I don't want anybody putting out that same story because somebody might think it's new news, and it's not. I can't tell you how many times I've seen, you know, publishers put out a story at 2:30 in the afternoon, and I go, well, I knew about that at 6:30 this morning.
Oh yeah.
Why did you put it out? That was useless. And
I say that to my guys all the time. Like, how is this news? It's like, how slow are people back? It always does surprise me that people react strongly to something that you knew about like a day ago or something. It's crazy.
Oh yeah. So one of the things I like to do is these trades in front of these shareholder meetings, right? And one of the nice things I have is this ability to pull up and see all of the shareholders meetings that are going on during the day. So if you look for today, boom, these are all the shareholders meetings that happened today. And stocks typically like to run into them. And I look for the bigger names because I always think the bigger names are, you know, are more likely to make an announcement, and they're more likely to say something positive. Because I look at these shareholder meetings.
You're not going to call a shareholder meeting and say something negative usually. So.
They're pep rallies. They're pep rallies for the stock. I mean, I didn't do this trade, but I saw Walmart was down $1.30 this morning, and I was like, wow, the shareholder meeting isn't until 12 or 11:30. This is the time to buy it because it's weak. I look up and it was down 30 cents, and you know, and now it's down 50 cents. But it was it would have been a nice, you know, opportunity. And they typically are looking for someone to say something hot. And if you remember Disney back in, I think it was November, they came out and they raised their guidance. They delivered, you know, great subscriber growth on their Disney Plus app that they have, and they did it all in a shareholders meeting. And that's why it's valuable, because the downside is so small, because they're, as you said, they're not going to say anything negative.
No, that's not why they're calling the meetings.
No. Wait.
So what's Google talking about today? Did that one happen?
Let's see what they say. Google to allow U.S. ads for cryptocurrency exchange wallets as of August. Okay.
Yeah, see, news like that is going to boost crypto, which is obviously a very useful thing if you jump on a stock like that.
Yeah.
Or one of the crypto exchanges, because that's definitely a plus. Can't deny that. Also read Apple is doing something with crypto in their wallet too. And I think some of this stuff may be you know, closing the barn door after the horses left or whatever. But you know, these things started to go into play as cryptocurrency was catching on. And that's something people have to realize as far as like investing on that kind of news. You have to also put it in perspective. It's like, if Google's announcing this and Apple's announcing this, these are things that were put into motion months ago when crypto was rallying and looking super serious and whatever like that. Then you have a giant pullback, and these initiatives are going to go on regardless. And regardless of crackdowns in China, and regardless of all the other backlash we're getting on crypto, you know, these things by themselves can't be taken out of context. But as a day trade, sure, this is going to be boosting crypto for sure.
Yeah. You see that Tesla's really getting whacked today, down 23.
Well,
I mean, yeah, we all know it's overvalued.
Tesla is my Moby Dick stock. It's like I just can't even believe it's $600 or whatever. You know, whatever number it is, it shouldn't be there.
Yeah, I mean, the fact is that the SEC laid down a rule any tweets that you do have to be approved by your lawyers or the board. You can't mess with the SEC because they will remove someone as a CEO. They have done it before. They'll do it again.
Yeah.
And the only reason I think he's been getting away with it is because COVID has kind of forced people to work out of their homes. And with the SEC now coming back into the offices, they're back on, telling Tesla, you know what, you fail to oversee Musk tweets. And
that's
they
right.
did.
He's had a year off from repercussions because all the SEC people haven't been around.
And you throw in the SEC story, you throw in the recall story, and you throw in that they had some lower revenue and they didn't meet expectations, and it's not good for the stock. And I now, and I think we were talking about this, is like, as soon as the other car manufacturers start to produce electric vehicles, Tesla's really going to have a problem because
Ford just had a showcase for the electric vehicles, and their lineup is across the board. It's going to be better, cheaper than Tesla for sure, more price efficient. Of course, Tesla's going to be flashy and cool and whatever, but for everyday electric driving, Tesla's not going to be beating that market. They're not going to get in there.
No,
and that's the problem.
And you want to be associated with Elon Musk.
Toyota has been quiet about the whole thing. Toyota's going to come in with a slate of electric vehicles next year, and but when Toyota announces it, they're going to be ready to put them in the showrooms. They're going to be mass producing them all at once. They're not going to just announce something and 3 years later roll it out.
Yeah. Well, Ford's planning to be 40% by the end of this decade.
Yeah.
I don't see the gas combustible engine going away entirely, but you know what? If you have a choice to make on a car, you really don't want to be stuck with a gas engine just because the resale value is going to really drop.
And 10 years. I think you're good for 10 years, but I wouldn't plan past 2035 to really, you'll have as hard a time finding a gas station as you currently have finding an electric station. I think it's going to swing the other way. Meanwhile, Tesla's just now sort of failing at 600. The market's pulled back a bit too since the beige book because there's nothing supportive there. It's just saying there's more inflation. The economy is moving along at the same pace. There's nothing exciting going on. And as I pointed out this morning, if it wasn't for $2 trillion worth of stimulus in Q1, we wouldn't be having any excitement in this economy right now.
No. The stimulus did help. There's no question about it.
Well, it better help. It's $2 trillion freaking dollars.
There's going to be you got to pay that back sometime, and the only way to really kind of not feel it is if you have a very robust and expanding economy. But
it's 10% of our GDP in one quarter. In the first half, it's 20% of our first half GDP. That's what $2 trillion is. 20% of our GDP was added through stimulus in the first 6 months of the year. We're only in month 5. How can you not have a decent looking economy? If you don't have a good looking economy when you put 20% stimulus into it, then you are in deep, deep trouble.
And it was cash, it was free cash. It was.
And it was mostly in the form of cash infusions. And that's just, and everybody acts like, oh, the economy's so healthy and so great. It's like the dead parrot sketch in Monty Python. It's like, it's like if you put 50,000 volts in it, it's going to move.
The economy's not horrible, but it's, to be at the levels we are now is really, that's
the trick. That's the trick, because this market is pricing in a fantastic economy. Record high numbers means you expect record high profits, record high sales, and all this, and it's not really there. It's there because of the stimulus, but it's not really there if you took the stimulus away.
Right.
And there's a reckoning there, I think, down the line. That's why we're staying out of these momentum stocks. We don't follow them. We're staying away from them because those are the ones that are going to fall to pieces without support.
Listen, good management and with solid product lines and, are always best to trade because they're not going to fall apart entirely. You go after some of these low float or smaller cap stocks or one trick ponies. They litter people's portfolios and they're bad trades.
Yeah, and that's the thing. Then when I see a movement in stocks, that goes for GameStop, AMC, whatever. When I see these things moving, I want to look at this news report. That's where I find this the most useful thing, though, is to say what made this move. What happened in the last hour or so? You go to the chart and you look. You say, when did this move start happening? And then I can go back, and that's what the greatest thing about your reports are, is I can go back and I can see through the time I'm looking at on the chart and say, this is what happened here. What justified this move? Like what moved today? Pets. Still, there's nothing as far as I know on pets, which is weird, right? Considering the move it made. But so on 6.2, there's two things. It says it surged 39%, and then it says it surged 36%, but nobody knows why.
Nobody knows why. I mean, it's one of those stocks.
So we kind of have to assume it's probably just a Robinhood kind of thing going on.
It is a Robinhood stock.
It's not, it's not crazy like AMC and GameStop, but it's getting a boost. But there's nothing that happened today at all that justifies this. Meanwhile, then we look at the stock though, and it's had the same kind of surge back on like 3-4 months ago. There was a surge similar to this in pets, and then you just look for the pattern and say, okay, since the same thing is happening now and the same no news is happening now, we can expect that pattern will probably continue tomorrow. There'll be a continuation of the squeeze. I already told my guys how to play it. We're selling the $45 calls for $10, and then we wait for it to come back down. We already long on the stock though because we expected this to happen a month ago, and we have this in our dividend portfolio. But this is what you have to do, and to have this kind of news at your fingertips is the strength of this thing, because anytime your stocks make a move, or anytime you see a stock making a move, you want to know why before you start putting money at it.
Why? Otherwise, it's gambling. Like I'm long a lot of Boeing, and my narrative is very simple. There are only two significant wide-body airplane makers in the entire world. There's Boeing and Airbus. There is nobody else. Combined, these two firms sold 0 planes last year. The airline industry has to continue to buy planes because they have to kind of continually upgrade their fleet. So there's going to be pent up demand for Boeing and for Airbus. So both of them are really likely to get a lot of orders over the next 2 years. And here was Boeing at under 200, and that was my feeling at the time. And I said, this is the year it's going to start running. And sure enough, next thing you know, it's 200, then 220. Now we're looking at 250. Yes, there's volatility. Yes, it'll go up and down for a ways, but they're on the right track. They paid a fine to the U.S. government for the issues that they had with the 737 MAX, a total of $16 or $17 million, which is a drop in the bucket for Boeing. And the skies are clear for them to continue to make planes and sell planes, and the demand is going to be there.
So we had the same thought you did back in April. We sold the $200 puts for $23. So we weren't brave enough to buy the stock because we were waiting to see if any more crashes happened. But it seems at this point, I'd say we're probably in the clear. The planes are flying again. Nothing more bad has happened. They seem to have figured out their problem and they've dealt with it. The fines are over, everything. So now there's no more wild cards. So I agree with you on that. What we did though is we started the trade by selling the puts. We sold 5 of the 2023 $200 puts for $23. So that gave us $11,500 in cash. And now, even though the stock has run up significantly since then, I'm not sure what it is on the chart, but so when we did that back in April, actually that's not true, because when we entered this trade back in April 13th, Boeing was about the same price it is now.
Right.
And what we wanted to do was see if it would stabilize. So basically, in the middle of April, Boeing was at 250, and we felt 250 would probably hold. It didn't hold. It went down to 220, but it certainly held 200, and that's what we cared about.
Yeah.
Now it's gone back to 250, but now it's sort of stabilized. So now we feel better about taking a bull call spread and adding it to that position and turning Boeing into a proper position again. But
yeah, they released their earnings on like April 29th, and then the stock took a hit after that day.
Right.
And I wasn't worried because I feel that the call is right, and in terms of selling airplanes, is there going to be a third competitor coming along? No, the moat is too big.
It doesn't matter anyway, because the reality is, I love the way people think of competitors as if it's like, oh, tomorrow we're going to start making planes. Boeing can only make, I don't know the exact numbers, but let's say they can make 500 planes in a year, tops.
Yeah.
I don't even think it's that much. But let's say they can make 500 planes in a year. Airbus can only make 500 planes in a year. Embraer doesn't have the same kind of, as you said, doesn't have the same kind of wide body planes, but they can only make, so let's say they compete with the 737. They can only make 50 planes a year. The Chinese company, whose name I forgot, they can only make 50 planes a year, 100 planes a year. They can't compete. You can't build up that fast. Boeing and Airbus both have 5 to 7 years of back orders on their planes. It'll take them that long to just fill what they've got. They're going to be operating capacity for years to come. The only thing that can really hurt Boeing is actually for the FAA to say your planes are unsafe to fly. Outside of that, though, people are going to just keep buying these planes and keep paying this price. And as Bill just said, you have to. It's like a taxi. It's like saying a taxi company won't buy new cabs. It's like you have to. This is your job. Your job is to take people from place to place in a plane. Therefore, you have to, when they wear out, buy new planes. There are X amount of thousands of planes in circulation right now. This many will wear out over the course of the next 12 months. These are not things that you can put off. And they're absolute. So the demand may cycle through up and down a little bit, and it may get derailed by a couple of things, but then it comes back. It's if you sold fewer planes this year, as he points out, that few planes were actually sold this year, then next year more planes will be sold, and it'll have to catch up over time, which means you're going to have some good years ahead with 10% extra deliveries or whatever else happens.
Yeah, I am like so comfortable with that trade. I've been telling everybody about it because I just think there's a good opportunity. Now, after the plane crash, I remember talking to one of my clients, and I was like, look at those 305 puts on Boeing. If another shoe drops, if something bad happens with Boeing, I got to tell you, those 305 puts are trading a nickel. I mean, it's worth taking a shot. And anyways, a week later, a bad news story hit, and the stock dropped like $10, $20.
Yeah.
And those nickel puts that my client purchased were worth like $1.80, and he called me up to say thank you. I was like, hey, good for you.
That's all.
I don't know. Listen, if you like my ideas, great.
Something for that. Come on.
Yeah, but he said he had a significant amount of them because it was so cheap. He liked the idea. It's like,
yeah,
all it takes is one bad story, and those nickel puts, they're going to go to zero. They're going to zero. They're going worthless. But if you buy, 50 of them, and something happens, that's a real payday. And sure enough, he got paid.
I got I did have a Google calls once. It was the earnings day, and I forget what the number was, but it was back in this is 10 years ago. It was earnings day for Google, and the calls that were like $100 out of the money were nothing. They were like $1 or 50 cents or something like that, some silly amount. So I'm like, I'll buy 50 of those for fun, whatever.
Right.
So their earnings were a blowout, and the stock actually went past my target price. And the thing is that what happened is while they were going up, the earnings were spectacular. They were obviously spectacular. So while they were going up, I said, oh, wow, this is fantastic. I said, I didn't want to sell my calls too early. So I layered them and I bought another set of calls higher than that so that when I took those off the table, I wouldn't feel bad about missing something. So I wanted to, like, as soon as I get a pullback, I'm going to take these off the table. So I did that. Then those went in the money.
Yeah.
And I did another set because I did the same thing in the next set. I leapfrogged another $50 ahead when I was taking the first set off. And then the second set was $50 higher. Then the third set was $50 higher. The second set went in the money. I'm taking the other ones off the table. So meanwhile, I'm up like $3 million on this frickin' trade. I got a visit from the SEC the next day asking me what I knew about Google. I mean, such a ridiculous. I mean, I'm talking about turning $10,000 into $3 million by doing that trade. And the SEC calls me and they're like, "What did you know about this thing? How did you find out? Who did you talk to?" It's like they couldn't believe I just lucked into it.
That happened to a guy at a clearing firm in Chicago. He bought a bunch of leaps in Yahoo when it was, $30 a share, what have you, and he forgot about them. At the end of the year, his accountant called him up, or his broker called him up and said, "What are you going to do with those Yahoo calls?" He goes, "I own Yahoo calls?" He goes, "Yeah, you bought some." He's like, "Well, what are they worth?"
Back in '99?
Yeah. When that went hyper, the year it went hyper, went up to like $200, and broker said they're worth, $2.3 million. He's like, "What?" Yeah. He retired, I think.
Yeah, right. What are you gonna do with it? Well, that ain't gonna happen again.
Yeah, you're not gonna see.
But mine was a day trade, and they just could not freaking wrap their heads around how that could happen in one day.
Listen, I worked at one of the brokerage firms I worked at. The SEC would come in and they would just sit there. They had nothing to do, so they would sit in the conference room for hours. And it's like, "What are you doing here? Ask us for some documents." No, we don't.
No, we just want to watch. we have nothing better to do. We want to watch.
They had nowhere to go, so they just parked their guys in our conference room. Look at this Amazon's Prime Day, June 21 to June 22. What happens to the stock during Amazon Prime Day? It rallies into the stock. So
right, we do that with Alibaba on they have their thing also, yeah.
You look at Microsoft. There was one I saw earlier on Microsoft.
They're going to be leads up to it. The thing is, though, I don't like Amazon long. That's where you run into trouble with something like that, though. I just can't bring myself to pay that kind of money for Amazon.
Yeah, it's if you time it right. I mean, it's not really a bad trade. It's not really a...
No, channel wise, they're not in a terrible spot at 3,200 since the top of the channel is 3,500. But $3,200 a share for Amazon is just insane.
Yeah.
That's where I have problems. It's just hard for me to wrap my head around this. I mean, Amazon, and also don't forget though, they're coming off a year where you cannot match these comps. They're going to significantly turn down in revenues now. The projections for them, I think, are completely unrealistic. $3,200 is $1.6 trillion for Amazon. Last year, they made $21 billion. And you're paying 1.6 trillion. So he's paying 80 times earnings for Amazon at this price. Now, the assumption is the projections last year, okay, in 2019, they did 280 billion in sales. Last year, 386. They jumped from 280 to 386, like a 33% increase in sales last year. 2021, they're projecting another 100 billion increase, 100 billion increase in sales. That's 20% of Walmart's total sales increase in 1 year. And that's what they expect for 2021. I don't think they're going to hit that mark. I don't think that just because you went up 100 billion from the 2019 to 2020 means you're going to go up another 100 billion in 2021. And then they expect another 100 billion increase in 2022. And I think that story is going to fall apart at some point. So then what you got to do is look at Amazon and say, well, when is their earnings? Because now you've got to say every earnings date with Amazon is like a minefield, and you have to worry about what they're going to be reporting and when. And you definitely want to watch out for any kind of guidance thing that comes out also. So if you're going to look for an alert, I'd be very concerned about alerts. But Amazon's next earnings is July 28th. So I wouldn't want to take any trade that goes past that earnings date, because it's very, very possible that, I mean, when you have to make 25% more money than you made last year, and you're having this prime event. See, now that's the thing. So leading up to the prime event, I wouldn't mind going long, but after the prime event, I would short, because they have to have such spectacular numbers not to disappoint when the expectations are this high. I don't see it. And I think next earnings is going to be a big problem for them. I think that the realistic projections are not going to be anywhere close to $500 billion.
Yeah, the Prime Day sales have typically been very helpful to them, but that's a big number to reach. Here's an easier one. It's a cybersecurity.
I think it's a weird time to call it. Calling it in June like that, I think it's kind of a weird time for them. I don't know why they're doing this.
They do it every year. They do.
But not June.
Well, they do it in July or August, I think.
Yeah. So I think they're pushing it because of I think they're pushing it because they're going to fail their numbers for the third quarter. For the second quarter.
So they need it.
I think they're already off track. And that means that by the time you get to July, their projection for the July quarter has got to be down, because they front-loaded the Prime Day.
Yeah, and then now you have to deal with what comes after this quarter, after the July revenue numbers. You can't guide higher. You're going to have an issue with your guidance.
Yep.
So either way, it's negative.
So meanwhile, I mean, the problem with Amazon is completely terrifying to short, but it's an interesting concept that if it goes back to 35, I would want to short it, but I certainly, I wouldn't have much heart for it right now. So conceptually, yes, going long into Prime Day right now, looking for a small boost, interesting play. But what I like better is as it pops up into Prime Day, I'd be looking for a shorting opportunity.
That makes sense to me. That makes a lot of sense.
All right, so
I did one of these cybersecurity alerts for a client of mine.
That's a good one too. Yeah.
Think about it. You throw in the names of the the security firms that are in this business. You use words like Russian hackers, Chinese hackers, and sure enough, you'll get first to notify, and they typically come out. There was one on who got hit. Somebody got hit today.
The beef, some meat company got hit yesterday.
Meat packing place got hit today.
A big one though. They're a huge distributor.
It was hackers out of Russia, and here's one where the MTA was getting hit by hackers out of China. I mean, this is not going to stop. This is going these black market type hacking incidences will continue, especially after the Colonial Pipeline one where the guy paid the ransom.
Did you ever read William Gibson novels?
No.
They're science fiction about they're science fiction. They were written in the 70s, 80s about the future, and the future he envisioned was all about hacking. It was literally his vision of the future was that corporations would be measured on the strength of their white hat defenses and their ability to protect their consumers. And there was this constant war of people attempting to hack corporations, banks, financial institutions, so on and so forth. That they were just groups of hackers everywhere attacking. Corporations would attack each other, and the best corporations had the best defenses. I think he's dead on. I think that's the inevitable future here. I think that, you're going to start depending on Apple to protect your data better than anybody else. Your personal phone and your accounts and such, Apple, American Express, and so on and so forth. Their jobs are going to become to be your cybersecurity people, for the individuals, and companies are going to have robust defenses against hacking. It's going to be a full-time part of any big company.
Yeah, I see IBM's up at $1.20 this morning, or this $1.20 this afternoon. they came out with a story this morning about how they're developing IBM Center for Government Cybersecurity for U.S. federal clients.
Yep. IBM was our stock of the year last year.
Yeah. You know, in 1987, IBM fell so hard, it took them 10 years to recover from 87 to 97 to get back that momentum to where they once were. It was overvalued in 87. But, you know, it's a solid company. They have really, they really are big blue. They made, you know, their networking services division is phenomenal.
Oh no, I'm a huge IBM fan. I made the case for them. Like I said, they were stock of the year last year. And people are like, IBM, it's so boring. I'm like, it's not boring at all.
I love boring.
I love boring, but I mean, to me, it's undervalued. I mean, how can you be bored by something that you can buy so cheaply when they've got so much invested in the future, and they weren't being appreciated at all for where they were?
Yeah, I mean, here's something that else is insurance. Insurance is boring. I have an insurance alert. I call it a hurricane alert. And basically it's, you know, follows a basket of insurance companies, and you throw in the hurricane name. You throw in those cataclysmic events that are likely to create, you know, significant damage, whether it's the name of a hurricane, a typhoon, or what have you. It really does. These stocks really do react to it. And, you know, Home Depot typically goes up because they, you know, the building materials in that area, there's going to be a need for them, where the insurance companies take a hit because they're going to be having to do payouts, but the insurance companies come back. I mean, that's really the best buying opportunity for the insurance companies, is during a devastating earthquake.
Right, but the question is the insurance. I was looking at that. It's interesting how little they were hit last year. If you look at the insurance companies, they did not take much of a hit last year. And I'm surprised. I would think, especially the life insurance companies, health insurance companies, you think they would have been paying out a lot more, but apparently this disease is not all that expensive to deal with. I guess a ventilator on the whole isn't all that expensive to stick someone on a ventilator and put them in a hospital. It's not as bad as cancer or chemotherapy or something like that.
I love the Johnson & Johnson trade, where they're talking about the blood clots, and they restricted the distribution of the Johnson & Johnson vaccine. And the story is that it's creating blood clots in individuals, so they need to stop distributing the vaccine. Now, if you follow the science says the drug is safe. And my brother-in-law's a physician, and he was dealing with a lot of these COVID patients at a research facility. And he goes, you got to follow the science, Bill. And I go, I don't follow the science. I follow the statistics. And the fact is, you got 6 patients with blood clots, and you've administered it out to 4 million people. Yeah, it's safe. I'm not worried about it. And sure enough, Johnson & Johnson came right back.
Yep. Yeah, I couldn't believe Pfizer was still so cheap a few months ago. I mean, it was just crazy. And
like at 33, when it was at the 33 level?
Yeah, it was down below 35, and I was like, this is insane. I mean, they're obviously the leading supplier of the vaccine, and everybody's so U.S.-centric. That's another thing I find always about the news and information. People are so U.S.-centric, and they can't get their head around, like, you know, everybody's like, well, Pfizer, they sold as much vaccine as they're going to sell. I'm like, no, there's like 4 billion people that haven't been vaccinated yet. They all have to be vaccinated, otherwise there is no point in us getting the vaccine in the first place. You know, you don't wipe out of something like this without vaccinating the entire planet. Has to be all vaccinated in the same year. That's how you stop a spread of something like this.
Right.
And it's like, and then people just don't get that. They just look over and they're like, oh well, I guess Pfizer sold as many vaccines as they're gonna. And it's just such a crazy attitude that people don't look outside this country. So they're, and not the resales and everything else. I mean, Pfizer's going to ride this for many years to come. You know, and so the other guys also. I mean, Moderna too. But Pfizer was just a bargain. And plus, Pfizer, this is all bonus money for Pfizer. They've got a perfectly viable company otherwise. Right. You know, with Moderna, this is kind of their whole thing. But with Pfizer, it's like they've got They make massive amounts of money. This is a bonus.
What happens to Moderna after COVID? You know, I mean,
Well, no, I
Pfizer,
think Moderna has a great future. I think Moderna is what they're doing and what they've done here is phenomenal. And I think that this is a future of medicine, basically, where they're at.
Yeah,
You know,
I don't see it
how
being able
often is
to
it
hold
going to
these
happen is the
levels.
question.
You know, but you know, Pfizer, come on, man, they pay a solid dividend. They're a Dow stock.
Oh yeah.
They're not going anywhere. I'm a big fan. And
No, that's why I said when we picked Pfizer, I said to people, I said, look, this is all bonus money. All this vaccine stuff. In fact, Pfizer has downplayed consistently the amount of money they're making on the vaccine. They don't like to talk about it because they're like, you know, they talk about their quarter, they talk about their numbers and so on and so forth, but they don't want to say, and we're going to make a fortune selling these vaccines. You know, they consider that in poor taste. They're basically saying, oh yeah, we're trying to help and blah, 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 and whatever. But meanwhile, there's an embarrassment of riches coming into the company. In fact, let me,
you know, I keep a small position in Twitter all the time just because, you know, waiting for it to go, you know, parabolic one day, because I think it could. All it takes is like one big news event where, like an earthquake, and Twitter is on the ground, and they're really able to grab those things and really able to report on them with firsthand knowledge. And you know, I just look at this thing, and I picked some up recently. What did I pick it up at 51.60, and I'm just sitting on it, you know, just because I think that this, you know, you look at the summertime, you look at, you know, the hurricane season, and this is when, you know, a breaking news story is going to hit, and, you know, Twitter could obviously carry it. So I'm keeping an eye on it. Something
I like Twitter, but again, it's the problem is I look at the math of how many people have been indoors shut up with nothing else to do, and how many people are going to be doing other things. I think people are very sick of social media and being indoors and playing with computers. And I think this summer is going to be a lull for all of these guys to some extent. We did pick up Facebook because they got cheap, but on the whole. But getting back to Pfizer, though, I just looked up the number. Pfizer in 2019 did $41 billion, right? And in 2020, did $41 billion in sales. This year, $74 billion. They're going from 41 to $74 billion in sales.
It's like 75%.
That's how much of a boost they're getting from the vaccine sales.
Yeah, I mean, it's enormous.
They're only going to double profits from 10 billion to 21 billion, a little bit more than double profits. But that's because, and I'm telling you this, that's because they are burying those profits into expenses and shucking them off and doing whatever they can not to show these profits that are rolling in. Because this is just insane money. They were running at a perfectly good profit before this, and now they're going to be running. Now they're going to be doubling their sales basically.
You know, you expand too quickly, it can hurt you. But if you do it right, and you hold the money back, and you start building it where you have those cash reserves for items that come up, where you have opportunities. This is where you develop really long-term growth.
And that's going to get right. And that's the point. They're going to be shoveling money into R&D and things right now. You know, because they probably have $10 billion worth of profits they're going to be looking to hide. And hide it means investing it in things and expensing it out in equipment and infrastructure and R&D and whatever else they can find to move it forward. But that's going to then benefit them down the road. You know, so that's going to be fantastic. And Pfizer, even at $39, that's only $215 billion in valuation, and they're making $21 billion. They're only trading at 10 times earnings. Now, will the vaccine continue forever? Probably not.
But then but when you're investing in your own R&D,
right, this still a very solid company.
Profit, you know, verticals come from.
Yeah. So what they're going to do this year? They're going to boost their pipeline tremendously. They might acquire somebody. They got a lot of things they can do with where they're at. And anyway, it's a shockingly underpriced company still, even though it's up 20% from where we came in. This is still ridiculously underpriced.
I bought some last year at 23, I think it was, and I was like, oh my gosh, it's Pfizer. They have a pipeline for 50 years. I mean, this is Pfizer. They're not going out of business anytime soon.
That's again the thing people don't understand about these kind of companies. These blue chip pharma companies they've got these very strong pipelines of R&D where they're not dependent on any single drug. That's what I like about Pfizer. I like that about Merck too. They're not dependent on any one thing to make or break their revenues. I mean, you look at Pfizer and say, oh, Viagra or whatever, but it's really 20% of sales total, and they've got so many other projects going. There'll be the next thing and the next thing and the next thing. But their ability to jump on top of this and come out as a major vaccine provider the way they did just shows you the strength of that company. And if you can't respect that, I mean, that's what investing is all about, is recognizing what this company can do.
Speaking of Merck, did you know Goldman put a $200 price target on the stock last November?
No.
I mean, that's a weighty call. I mean, $200 on Merck when it was $75, $80. I mean, it hasn't moved much. But
well, so are they right or are they not right? See, now in Merck's case, though, they're valued around the same as Pfizer. That's 190 billion. I don't see where Goldman's getting it, because Merck, on the other hand, they did not. They failed the COVID race, right? They didn't come out with anything. $75 for Merck is $190 billion, and they are going to make about 14 billion in profit this year, 15 billion in profit, let's say. So realistically, they're trading at 13, 14 times earnings. So they're nowhere near what Pfizer is, and how they could possibly jump to 30 times earnings to hit Goldman's target, I don't see it. I don't see where they're pulling that number from. So I'm not surprised that they're not going to make it.
I gotta go back and read the report, but I wonder if they were instituting growth aspects due to COVID.
Right, that's the thing though. They lost the COVID race, and frankly, I'll tell you, I predicted this back in March of last year. I said Pfizer was going to win the COVID race. They were our first pandemic pick, in fact. In I don't remember if it was January, February. It must have been like February or March of last year. I picked Pfizer. It was our first official pandemic pick because I said, here's why. Pfizer has this and Pfizer has that and Pfizer has that, and therefore they are the most likely ones to. Oh, I know what it was. They already had so much work done on the last strain of the virus. So I was like, there's no way that they're not going to be a leader in this development, because they've been working on the other strain of COVID that was out before for the last 5 years. So don't tell me they don't know what they're doing. They're going to be ahead of everybody.
What you're saying to me makes absolute sense. What you're saying adds up and it makes sense. And I like that. That's a good opportunity when you talk it out and you walk your trades through it and you have those building blocks of proof and you can back up your trade with your positions. Yeah, that's you make an excellent point.
Yeah, I mean, and again, that's one of those things. It's like, it was so obvious at the time. I couldn't believe I had to argue with people about it. I was like, people come back to, well, this and that, and what about this one, and what about that one, all these little biotechs and whatever. And I'm like, those
little biotechs are really risky. They're one-trick ponies, one-trick ponies. Yeah, they can show volatility. Yes, there's money to be made, and I am not questioning it. And I do it myself, but I also know there are short-term plays, because a one-trick pony is either going to get bought up or it's likely not going to be able to, sustain a significant move higher. I mean, you look at something like, Dropbox, which, Dropbox, I believe, is doing very well, but what do they do? They've got one product and that's it. And that's a problem for them. I think that, they're going to have to, they're more likely to be acquired.
Right. Yeah. To me, it's like I'm a Goliath better. So Pfizer's like Goliath, and other companies, little biotechs, are like David. And it's like, okay, fine. One time the kid with the slingshot wins. But meanwhile, I made 100 winning bets on Goliath until that point.
Yeah.
You know, so it's like over the course of history, betting on the giant is the way to go, not betting on the kid with the slingshot.
I remember writing about, COVID in January last year, and I was just like, this is going to hit the travel and leisure stocks, the casinos. It's going to hit, the airlines. And I listed all out the industries. I said, these are the sectors that are really going to take a hit. Now, I wrote that that piece in January.
Right.
The market really didn't slap these stocks down for another month and a half. But boy, when it did, it took 6-9 months for these things to recover, and some of them won't recover.
Yeah, see, that's the thing. We didn't go back in, like we got out, which was, we got out, but we didn't short them because frankly, I didn't think this was going to last so long. I really thought it was going to be over in 3 to 6 months when it started. I figured it'd be like a seasonal flu thing, not so much the way it turned out. But nonetheless, we certainly didn't jump in. We got out of our travel stocks. We thought that was going to be obviously disrupted. It's obviously going to be disrupted for a year, no matter, even if you come back in July, it's still, you lost the year. But what was interesting though, and the reason we didn't get back into them even when they got really cheap, was the losses are catastrophic. These airlines lost $2 billion, $4 billion, $5 billion last year.
And the cash burn.
Yeah, just because they come back, now they're saddled. They're the same company, and you can say, oh, sales recovered and everything's rebounding, but now they've got a $5 billion debt they didn't have before. They either have $5 billion less cash, but hardly any of these airlines had any cash. So basically, they've all got $5 billion worth of debt they've got to pay off. It's like, sure, they survived, sure, they're coming back, but their profits are going to be impacted for years to come because of the debt repayments. And that's a lot of these companies like that. A lot of the restaurant stocks are like that. A lot of the airlines, all the travel and leisure industries. You got to look carefully at what they lost and what they're carrying now as a debt load compared to where they were 2 years ago. It's fine if sales come back. And that goes back to my whole problem with the market. It's great to say, oh yeah, things are coming back. But things are coming back, but corporate debt is at a record now. It's much higher than it was in 2008. Corporate debt has never been higher than it is right now, and they've got to carry that burden forward. They can't just print money the way the government does.
And you don't know the loan terms, and you can't refinance a loan, and you're not going to be able to refinance a loan at a lower rate in the future.
Oh, and that's the other thing, right? Yes, and then the rates is 0, so they're not going to get better. They can only get worse.
Yeah, I mean, it's good for the banks. When you start raising the interest rates, hey, the banks make, this is their opportunity to make more money. They do it in a couple different ways, so they're all for, increases in interest rates. But these companies, I don't think they do floating loans, obviously, but you're not going to get interest any cheaper than you're getting it right now. Now is the time if you're going to do it, you have to do it. But the question is, did they go too far? Are they carrying too much debt? They probably are.
Yeah, so I mean that's just my word of caution for anything travel and leisure is you've got to look at the debt. You've got to compare the debt they have now to what they had in 2019 and say even if they get back to the same level, it's not as good.
No.
Sales returning to the same level is not the whole story. And neither is short-term profits at the same story, because what happens to that debt when they have to actually start paying interest on it? That's really the question you got to ask yourself, because that's going to be hitting a lot of people really hard. And then you say how much
one quarter, you can blow out the sales. That still doesn't do anything to your profits. Profits is really the key there.
Yeah. Where did I see that? All right. Anyway, so we got to wind this down, so we don't have that. Can't go too long on the recording.
All right, let me put you back on your screen here.
I think that's something I change presenter. Yeah.
You got to press a button.
Do I have to do something? I don't think so. It's waiting to view Bill's screen, it says. Uh-oh. Oh, make present to me. There you go. Let's see what happens.
There you go.
Oh, wait, you can see my screen now?
Yes.
Oh, okay, fantastic. All right. Well, all right, guys. Bill, thank you so much for coming. It's always great talking to you.
I enjoy talking to you, Phil. I really do. You're a good guy.
And yeah, and again, is there anything you want to say about Newsware before we go, about getting on it and moving over to it? Where do we send people to sign up?
Newsware.com is our website. If you're interested in it, checking out what we do, just send me a note. We've been doing this for 25 years, and we deal with the professional news wires. We deal with breaking news, and we filter it down into small segments so you can really act on it. And if you're doing research in the morning, there's nothing better than being able to drill down into news stories to find out really what's going on. And that's what we deliver at Newsware on a daily basis.
Yeah, I mean, guys, it's I mean, Yahoo Finance has some news, but so much of it is crap. And if you want real information, you want to know what's going on, you tap in your symbols into Newsware. Aside from the alerts and the screens and the other stuff that you can get on it, the bottom line is when you're about to buy a stock or sell a stock, or if you say, what the hell happened? Why did the stock move like that? You just punch in the symbol in this thing and you see everything that's going on, and you see it up to the second. And that's exactly what you want to do. And you guys, most of you subscribe to me. I'm a very news-oriented person. I'm very information-oriented. It's, tools like this are invaluable. And especially if you're a short-term trader and you need to make a decision and you need the data. The data comes from a service like this. It's so well worth it. And I really encourage people to check it out. Anyway, thank you so much, Bill. I appreciate you coming. Thanks, everybody else. We will be doing this again next week. All right. Thanks. Have a good day, everybody.